Um, we're going to kind of change. The next slide is going to show you how you look at investing. So maybe let's say the experts don't want us to know all these things, but when it comes to things like RESPs or RSPs or mutual funds versus real estate, let's look at what those really look like. So let's assume we have a $500 a month investment. So a lot of people do this. Maybe take a little bit off your paycheck, and you're investing, $250 bi-weekly, gives you a $500 per month investment. If we have that 12 months, 15 years with a 5% return on investment, I think we would all agree that, a GIC is tough to get at 5%, but if you've got the right investments in mutual funds, a 5% return on investment over long term is probably a pretty good return on investment. So after 15 years of putting this money away at $250 per paycheck, leaves you with about $135,000 over 15 years. Pretty good little investment. Now, if we take that saved $500 and let's say we take that money off of instead of putting it into an investment, we invest that into real estate. So in the form of taking out, some equity out of our property, taking that $100,000 line of credit maybe, and having a $500 a month investment go towards real estate versus going into our mutual funds that we're doing right now. So borrowing that $100,000 down payment costs about $500 a month. And we buy a $500,000 property. We've owned that for 15 years. We get that same 5% appreciation that we're talking about, that we've seen in the housing market over the last 30 years. Our mortgage after 15 years is going to be paid down to $277,000. Remember that tenant that we're going to help you find, and get in there. We've got a team to help get that in. They're going to make those mortgage payments. We've created the equity of $762,000 minus our $100,000 initial down payment. That leaves us with a profit of $688,000 after 15 years, right? That's a 502% higher return on investment when you're looking at 134,000 versus 688,000. Now, let's play what if. What if real estate only appreciated at 2% instead of 5%? Mutual funds, RSPs, let's say they were at 10% instead of 5%. So numbers that we really haven't seen, and we've got some really, really different adjustments. We're still going to have $167,000 in investments and $323,000 in real estate. So instead of our 500% higher return on investment, we're going to have 193% higher return on investment. Let's run the race the right way. And what I would say is the only way. Now let's kind of play absolute worst case scenario. Let's assume that your property never goes up in value. Now what? Our profit after 15 years, we're at $151,000 in real estate. Take that at investments at 5% return on investment, you're at $107,000. We're still winning the race here, right? If we take that out over even longer, over 20 years, I'm in the way of that, but I can tell you, you're still at $220,000 return on in real estate versus $165,000 return on investment in mutual funds. Now, what if we could accomplish this without increasing your current monthly budget? So, old school way of thinking, pay off your principal residence as fast as possible. I know that's what my parents taught me. Pay that off as fast as possible. And now your investments plus the equity in your home, that equals your retirement. Now, new school way of thinking, use your principal residence as a vehicle to buy more real estate, right? Take your investments plus your equity in multiple properties that we've built. That's going to equal your retirement. What I would call living the good life.